Greetings, everyone. We welcome you to this edition of InSync with BDO India. We also welcome Nilanjan Paul, Partner Risk and Quality, Audit and Assurance in MSKC and Associates LLP. Today, Nilanjan will help us navigate the regulatory landscape, particularly relevant for the year end financial reporting. Over to you, Nilanjan. Thank you for inviting. And we will like to start with the year end roundups. Uh, in these sessions, we generally talk about how the year has gone by, what have been the financial reporting updates, and how should you prepare for the year-end reporting of March 26. But before we go into more technical updates, what we felt is relevant is to discuss about the effect of geopolitical uncertainties that might have a potential effect on financial reporting. So I'm sure you all are witnessing the news about the disruptions that is going on in the Middle East. This, for everybody's knowledge, has fueled the existing uncertainties and geopolitical instability across the globe. So we already had a few uncertainties in the last year. Those uncertainties had now become more aggravated because of the ongoing geopolitical conflicts. So if you look at volatility, we believe that volatility is now the new normal. Uh, it was important that we discuss about this because the volatility might have a diverse effect on the financial statement. It might have a very, very pervasive impact. So if I have to take you to this slide, uh, there is a serious stress on the global supply chains, uh, primarily because of the choke point in the Strait of Hormuz, which affects and the entire supply chain for very critical items that comes to India, be it the crude oil, be it natural gas. Because of the geopolitical conflict, the choke point has is yielding much more pressure on the global economy and also as a result fueling energy prices. So because of this volatility, there is a possibility that the crude oil prices or the energy prices continue to remain volatile, and as we can see now, they are moving towards the increasing side. Because of these important geopolitical disruptions, there are also pressures on inflation. The costs of goods that we procure, the entities that they are import dependent, or entities who purchase locally because of increase of uh, the energy prices, freight, and other considerations, there is a possibility that the inflationary pressures would continue to mount. The Indian rupee has been depreciating for quite some time, and recently it has reached a record level. Now, because of the country became being import dependent, the global uncertainties is also affecting the depreciation of the Indian rupee, right? Which is also increasing the overall inflationary pressures. The volatility in the market has also led to steep loss in market capitalization. We have seen that there had been serious reduction in the market capitalization of BSE and the Nifty indexes. Now, because of all these risks, there are obviously financial reporting implications. So if I have to pick up a couple of them, the effect of these uncertainties on judgments and estimates would obviously become aggravated. The ability to reliably estimate the uh, prospective financial information that might get more and more difficult. Because of the conflict, we one possible implication could be invocation of force majeure clauses in various commercial contracts, be it a lease contract, be it a purchase contract. We need to be conscious uh, whether there are any onerous loss that the entity would need to assess. Going concern and impairment. I think the abandonment of assets, or if an entity is dependent on a particular set of customers which is located in a war affected jurisdiction, possibly there are high chances of of an impairment trigger being present, or the continuance of the entity as a going concern might also come under clout. Discussions on appropriate discount rates. So, for example, whether these are risk-free rates, whether they are reflective of the particular CGU, those estimation gets uh, subsequently difficult. Modeling of losses, for example, expected credit loss, uh, recoverability of deferred taxes, these might become increasingly difficult to assess. Because of the conflicts, the continuance of existing relationships, be it a subsidiary, associates, or joint venture, might require further scrutiny and further discussions. Share-based payments, if they are performance-linked conditions, possibly these have to be assessed much more carefully. But what we believe is a very common phenomena is a more clearer and granular disclosure of uncertainties that we need to include in the financial statements. From a financial reporting standpoint, the users, especially the investors, would be interested in much more tailored and high quality financial reporting disclosures. So the effect of these geopolitical uncertainties should be very clearly brought out in a very transparent manner by the preparer of financial statements. Yeah. Moving to the accounting changes that are relevant for the financial reporting of FY 25-26. During the year, we saw a couple of amendments in Ind AS 1. There is a criteria uh, which is known as right to defer settlement when we classify a liability as a current or a non-current. So effective 1st April 25, this criteria for right to defer settlement has been modified. Earlier, a right could have been deferred for settlement if the right was unconditional. Now there is a slight change in that criteria. Uh, right now, the classification as a liability can be current if if it has a right to defer settlement. Earlier, it was an unconditional right. Similarly, for settlement of liability, if the liability is settled by its own equity instrument, that is considered as a settlement, except for certain specific scenarios. For example, where the option of a compound financial statement is classified as an equity. Uh, there are also discussions about testing of covenants at what is that point in time when the covenant should be tested for compliance. Now, if the covenant is expected to be breached by the year end, but those covenants are expected to be tested only after the end of the year, how should, in that scenario, the liabilities be classified? The Ind AS 1 have been amended, again effective April 25, to, to clarify that the right to defer settlement must exist as of the reporting period and covenant compliance. So in a nutshell, what we're trying to say is that the right to defer settlement, right, or the testing of covenants, they have to be looked at only for those covenants which are existing and tested as of the year end. If those covenants are to be tested after the end of the year, then for financial reporting March 26, those covenants are not relevant. Uh, there has been increased focus on disclosures. For example, disclosures have been introduced about covenants, uh, the information about covenants and difficulty in compliance of these covenants. Also an important update which is effective from 1st April 26. Ind AS 1 had a carve out where as compared to IS 1, in India, we felt that if there is um, uh, a non if there is a breach of a material provision, right, of a loan contract, and this and that has been remediated, right, in that scenario the liability can still be construed as non-current. Now effective 1st April 26, this carve out is now being removed. So again, the message on this slide is that the removal of carve out that is there in Ind AS 1, that will be removed from 1st April 26, and the covenants to be tested as of the year end, right? So for the classification of liability as current or non-current, the covenants which are existing as of the end of the year or which are required to be tested as of the end of the year would only be relevant for classifying as current or non-current. Yeah. Similarly, effective 1st April 25, there were amendments relating to supply chain arrangements, supply finance arrangement. Now, simply put, supplier finance arrangements is where the finance providers would pay amount that an entity owes to its supplier, and the entity pays according to the terms and condition of the arrangement, either on the same date or later than the supplier is paid. Now, there are very common instruments that we have seen. We have supply chain finance, we have payable finance, or we have reverse factoring arrangement. But in a nutshell, these type of arrangements helps the entity to manage its cash flow, right? And also take the benefit of extended payment terms. But so again, the amendments have been made in Ind AS 7 and Ind AS 107, where they have clarified that there are certain disclosures that should be included for these arrangements. So these amendments do not clarify when should the arrangements be classified as a liability or as a borrowing, but the focus on these amendments are to introduce enhanced disclosures. Uh, we also saw in the current year the enactment of the new labor code. So effective 21st of November 2025, the government had notified 4 new labor codes. Uh, they are the Code on Social Security, Industrial Relations Code, Operational Safety, Health and Working Conditions Code, and most importantly, the Code on Wages. These 4 codes consolidate 29 existing laws. So these new codes are very, very relevant in the today's scenario, and they are meant for new India. Now, obviously, when there is a change of laws and regulation, what is generally expected is that we need to align policies and contracts. We need to revise the internal controls of that particular entity. There had also been certain clarifications by the ministry that till the time the enabling rules are being notified, we need to follow the existing rules, right? So that might be relevant for 31st March 26 reporting. But what in a nutshell these codes tell you is that there are enhanced benefits. There is a clear-cut maximum cap on the exclusions that should be done to compute what is wages. So in the past, there has been concern about under accrual or underpayment of social security benefits, but now the ministry has introduced a very innovative definition of wage. What they are basically saying is that all allowances, right, should be more than 50% of total remuneration, right, and then that should be a part of wage. So for example, if you have 100 and you have exclusions from the wages, that is, let's say rupees 60, you can have maximum exclusions up to rupees 50, right? So it is not the wages which should be 50% of the total CTC, but it is the exclusions that is limited to 50% threshold. So what happens is that because of the new definition of wage, the all the benefits that is due under the four labor codes, right? They have to be computed based on the definition of wage, right? The ministry also proposes to fix a national floor wage, right? And as far as March 26 is concerned, that has not been fixed, right? There are also new benefits which the code envisages. For example, for fixed time employee, they would like to achieve a pay parity, uh, and there had been very innovative measures that have been introduced for fixed time employees. For example, for them, the gratuity, instead of being due at the end of fifth year, the gratuity would be due annually. There is also a paid annual leave of 18 days that is mandatory under the new labor code. They have also mandated health checkups mandatorily in certain cases. Now, there had also been expansion of existing benefits. For example, the wage code would cover all employees, right? For example, the earlier it, it didn't cover senior management employee. Now the wages code covers all employees, which includes senior management. Social security schemes are being expanded for unorganized gig workers and platform workers. Uh, Maybe some other of the key nuances of the labor code. Gratuity norms, they continue to remain unchanged, except for the fact that the gratuity would now be computed as per the new definition of wages. There is a 1-year transition period that has been put for the provident fund. So for the next 1 year, the provident fund computation and the manner it is implemented, that continues to remain unchanged. Principal employer, they continue to be the primary uh, 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 obligor of these benefits. Previously, they were considered as a secondary obligor of these benefits. So again, a very interesting change as far as the labor law framework is concerned. We expect that as and when the entities would read the new rules, possibly they would have they might encounter certain of the compliance and reporting challenges. Again, labor is also a state subject. What we have also seen is that many of the states of India, they have also formulated, or they're in the process of formulating the the rules for the particular jurisdiction or the particular state. The preparer of the financial statement might need to also watch out for these state level rules. From an accounting standpoint, ICI had issued a clarification because due to increase in wages, there might be an increase in gratuity and leave liability. So first things first, for accounting year which are ending before the enactment of the labor code, So if my accounting period is ending before 21st of November 2025, then obviously this is a non-adjusting event. But if the accounting period is ending after, for example, 31st of March 2026, the amendment or the new labor code would be an adjusting event. Now, as a result of the fact that March 26 is an adjusting event, right? Uh, the accounting of gratuity and leave liability might get affected. So, for example, because of increase in gratuity due to plan amendment, right? For example, the salary that we have been using to pay gratuity, that has undergone a change because we need to align with the definition of new wages as per the labor code. In that case, for Ind AS compliant entity, they have to be recognized in the profit and loss account, right? Immediately as an expenditure, right? For entities which are following accounting standards, to the extent my vesting period has expired, for example, I have already passed, let's say, the 5-year uh, cap, then to that extent it has to be recognized immediately. Where the vesting period has not yet been expired, in that case the amount has to be amortized over the vesting period. But any increase in gratuity because of uh, alignment of wages with the revised definition of wages, it will have to flow through the profit and loss account. The timing might change because if you are following Ind AS, they have prescribed a different manner, but if it is AS, again it is a bit different. Uh, if there is a change in gratuity due to change in actuarial assumptions, for example, there is an increase in total remuneration, the salary increase that we look at. Now, in that case, as far as Ind AS compliant entities are concerned, these qualify as changes in actuarial uh, assumptions, and they need to be recognized in the other comprehensive income. Uh, for entities which are following accounting standards, there is no concept of other comprehensive income. So even to that extent, it has to be recognized in the profit and loss account. As far as the leave liability is concerned, any increase in the amount of leave liability has to be recognized immediately in the profit and loss account. Now, because of these changes, we would also expect consequential changes in the current and deferred taxes. There might be a need for adequate disclosures. The entity would need to also look at and assess whether this tantamount to an exceptional item. But when you are considering disclosure as an exceptional item, please consider whether the materiality and incidence test is met, right? It is not that every item which is material would qualify as an exceptional item. It also need to meet the test of incidence, right? Uh, Now, another consideration that can can you argue that the enactment is a non-recurring event, right? So in that case, the labor code would become or the effect that is recognized in the financial statement should be disclosed as an exceptional item. So again, these are the few considerations which people might apply when you need to assess the effect of increase in gratuity and leave because of enactment of the labor code. Okay. Now the the ICAI has also released the draft Ind AS 118. This is a new format of presentation of your income statement. Uh, like we had Schedule 3 under the Companies Act 2013, there was no corresponding layout or format in Ind AS 1. Globally, also there were certain challenges in comparing like-to-like information for various entities. So globally, a new accounting standards had been issued. It is also now been proposed in India by the ICI. It has gone through the approval of the NFRA, and now it is pending with the ministry for approval. Right now, Ind AS 118, the proposed Ind AS 118, they don't prescribe a new accounting or a reporting mechanism. They would only spell out how your income statement should be looking at, right? So it carry forwards a significant part of Ind AS 1. So, for example, the comparative information, classification of current and non-current liability, going concern, capital disclosures. Many of the concepts under the existing Ind AS 1 is expected to be carried forward under Ind AS 118. Now, what Ind AS 118 is proposing to introduce is a structure for categorization of statement of profit and loss. There are particular mandatory totals and subtotals that has to be included in the income statement. Management defined performance measures, or MPMs. Globally, there were requests that the measures which the management use for the purpose of looking at its performance, they might need to be disclosed, or they should be disclosed in the financial statements. Earlier, these were never made part of the financial statements. They were either included in the board reports or other reports which was forming part of the annual report, but not financial statements. But under Ind AS 118, these would now forming part of the financial statements. There are also discussions about aggregation and disaggregations of income and expenditure. And from the transition and effective date, what has been proposed to the ministry is to make this effective from financial year beginning on or after 1st of April 2027. Right. So this is going to be an interesting standard, and we need to watch out. Uh, as far as the gravity is concerned, this is the most significant change after we had seen the last standard being introduced, which was on leases. But after that, this would be the most significant change from a standard perspective. This is again a worked example, a very high level example that we could uh, that we have put to explain few of these changes. So, for example, we'll have mandatory total for operating profit. We have a mandatory subtotal for profit before financing and income taxes, and then we'll have a mandatory subtotal for profit before tax. Few of the items might get rearranged. For example, other income, which were earlier part of total income, might be shown differently. Similarly, finance cost might be shown separately or differently. So, but what we also want to caution is that these are proposals, and because we already had Schedule 3 to the Companies Act, we need to see how both the standard and the Schedule 3 will interact in the upcoming future. But again, a must watch for preparer of financial statements, and we'll also keep you posted when these changes have been enacted. Okay. Let's talk about the NFRA roundups. There had also been a couple of discussions and a couple of very important clarifications which the NFRA has issued. Now, the most important being, so the first question is, who is TCWG? Who is that body where the discussion should be carried on, right? So if I look at the standards on auditing, SA 260, it defines TCWG has the responsibility of overseeing the strategic decisions of the company and obligations relating to the accountability of the company, right? Generally, the board of directors will qualify as TCWG since it has the overall responsibility of the governance of the company. That is obviously the view which the NFRA has laid out very clearly in the circular. But they have also acknowledged that a subgroup of the board can also be, TCWG. In that scenario, the audit committee plus some board members can comprise of TCWG. Now, what does that plus means? The NFRA circular doesn't put a minimum or a maximum cap. I think the idea is to give enough flexibility to the management or to the entity to constitute TCWG, which fits their purpose, right? So again, the NFRA circular will only give directions. It is up to the entity how they want to implement in substance these uh, expectations of the NFRA. About the timing of communication, the circular clarifies that the meetings or the communication should at least be semi-annual, right? So that means twice in a year, there has to be a meeting between the auditors and those charged with governance. But for larger listed entities, where you might have quarterly board meetings, the circular clarifies that in those scenarios, the meeting should be held in such a manner that the quarterly board meetings are also facilitated. Importantly, the circular envisages that if there are difficult scenarios which the auditors encounter in an audit, for example, a fraud or a significant weakness in internal controls, or there are difference in views between the management and the auditors about significant estimates and judgment, and the auditors wants to discuss these with TCWG, the TCWG would either accede to those requests or give written reasons for not having uh, a time for discussions. So again, the timing of communication, both frequency as well as the content, they have been very clearly been laid out in the NFRA circular. The minimum agenda item, they obviously cover significant transactions or events where the management has encountered significant difficulty, significant material weakness in internal control, accounting estimates that involve judgments and estimate, and auditors' compliance with independence and ethical standards. So these the NFRA circular felt should be the minimum agenda items. Okay, let's move to SEBI and other roundups. Now, SEBI has issued certain clarifications as far as the financial results are concerned. Uh, there had also been FAQs which the Bombay and the National Stock Exchange have issued. So if I have to talk about standalone financial results first, if uh, the if there are no subsidiaries, associates, and JVs, the FAQs of the BSE and NSE clarify that in the standalone financial results, it has to be very clearly articulated the reason for non-submission of consolidated financial results. The FAQs also state that if there is a requirement to submit consolidated financial results and they have not been submitted despite the fact that the entity has subsidiary, associates, or JV, there has to be a proper disclosure in the financial results standalone level why the consolidated results are not being submitted. Now, a few more clarifications which are relevant for both standalone as well as consolidated financial statements. If an entity is a single segment entity, in that case, Ind AS 108 or AS 17 would prescribe certain disclosures. Now, in that case, for a single segment entity, those disclosures have been stated to be included in the financial results as well. Uh, if few subsidiary, associates, and JVs are not consolidated, so these should also be explained uh, in the consolidated financial results. If the amounts are same in both standalone as well as consolidated financial results, then the reason for that should also be disclosed. Now, as far as SEBI is concerned, they have clarified that if a director who is other than a chairman, MD, or a whole-time director signs the financial results, then the authorization document or disclosure declaration should be included in the notes to the financial results, right? So again, very important clarifications, and we would urge the preparers of the financial statements and the SEBI results to consider them for their March 26 reporting. Uh, in the current year, we also saw significant focus on SEBI's RPT rated norms. So the Industry Standards Forum, which have been set up by the SEBI in coordination with various industry associations, they have come up with a standard. Now that standard basically spells out what are the minimum information which the audit committee and the shareholders should expect as far as related party transactions are concerned. So there have been requests where the audit committee felt that there is no standardized list of requirements that that has been prescribed by SEBI, and because of that there is a lack of congruence. Sometimes the independent directors are not provided with adequate information for the decision making purpose. Now that has been plugged now through the issuance of the RPT standard. Uh, they would apply again from a particular set of related party transactions, and what the SEBI has said that they would apply to RPTs which are not small value or for which simplified disclosures are not applicable, right? But the moment you cross these thresholds, there the industry standards become applicable. Now, the industry standard is also dynamic. It is not a fixed kind of a list of requirements. The level of information that the entity would need to submit, it changes because based on the type of transactions and based on their materiality. So, for example, Part A, right, the first box on the left, the information prescribed under Part A, right, which is the basic information of the entity, its relationship, and all that, that has to be submitted for each and every RPT. Now we move to Part B, where you enter into 7 specific type of RPT, right, and you can see them on this slide. Now, if you are able to enter into these type of transactions, then there are additional disclosures that needs to be provided. Moving to Part C, if there are disclosures uh, for material RPTs, right? So again, we have additional set of disclosures. So basically, what we're trying to say is that the level of disclosure changes based on the type of related party and the materiality of the related party. Again, the information that is to be prescribed to the shareholders, that also has been uh, provided. So again, the standard basically would help the management to give the audit committee and to the shareholders a uniform list of data points which would be relevant for decision making by the audit committee and shareholders. So for these also, there has been certain clarifications that has been issued by the National Stock Exchange. We would also urge you to consider these clarifications. Now, other amendments as far as the RPTs are concerned, the threshold for approval of shareholders on RPTs, that has also been changed. Earlier, the existing threshold was 1,000 crore or 10% of annual consolidated turnover of the listed entity, whichever is lower. That has now been substituted with a scale-based threshold. So if the annual consolidated turnover is up to 20,000 crores, then the threshold is 10% of the annual consolidated turnover, so on and so forth. So my threshold changes based on uh, the the range where the annual consolidated turnover is. Now, where an RPT of a subsidiary, where the listed entity is not a party. Now, for RPTs more than a crore, prior approval of the audit committee wouldn't be required. If the RPT is lower of 10% of last audited annual standalone turnover, right? That is the existing norm. What they have also added is the scale-based threshold, right? Retail purchases that are not RPTs. So, for example, if the retail purchases from the listed entity or the subsidiaries by the directors or their relatives, or KMPs or their relatives, those are not considered to be RPTs. Now the only caveat is that where the business relationship or the terms are uniformly applicable or offered to all the employees and their relatives. Yeah. So I think that's all we had to cover from a year-end roundup perspective. We're also in the process of preparing a publication which will cover these year-end roundups, and we'll be sharing it out in public domain. Uh, we'll be happy to hear your feedback and comments. But till the time, thank you so much for joining our session. Thank you.